Good evening, class, and welcome to our performance management class for today. We are discussing the topic transfer price or transfer pricing. In the last class, we talked about the concept of transfer pricing, that it is prices that units in a group of organization transfer goods or services to one another instead of the technical word used as sell, we use transfer. And so when we do transfer, it doesn't really increase the organization's income or reduces or increases their expenses. It's just internal transfer. We saw some questions where we had to look at transfer pricing at variable cost, transfer pricing at full cost, transfer pricing at market price, and opportunity cost. We also said when you are giving question in exam, you need to look at the company's policy. The company's policy is the guiding principle in the exam. So look out for the company policy, look out for the transfer pricing policy. These two things will aid you to be able to give out good answers. And we said sometimes it's good to uh, see what will happen when the company transacts within each other and when they are transacting outside. Which one will benefit the company as a whole, not the individual benefit. The company as a whole is, or the group as a whole is what is more important. So we call that goal congress, group's goal congress. So if the overall objective of the group, if we increase the income, the profit of the group, irrespective of the increase or decrease in profit of individual sector, then we are working as a group. Today, we are going to look at past questions. And we have our question trend here. We looked at question 16 and question May 2016, question 6, and May 2017, question 7. And I think we have looked at question 5. I wouldn't know if we have looked at question 5, but there's another thing we should try to see which other questions have transfer pricing. This is transfer price and divisional performance. This one here, transfer price and divisional performance. Let's see what again have we not looked at. We have also not looked at this. So this one and this has not been looked at. So these are the two things that are remaining. Let's check again. I think these are the two things remaining. So let's start with May 2018. Question 1. May 2018. Let's look at question number 1. So I'm getting the past question ready now. May 2018. Question number 1 will soon be opened. Okay. We are going to look at one. May 2018 rather. I keep saying 2016. So let's check performance management. Okay. I'll come back to this question because this is talking about divisional performance. We will do this particular question when we've done divisional performance. We will do this particular question when we've done divisional performance. So permit me not to do this one now. So let's look at number 2018. November 2018, question number 2. All right. Right, so this is the question. Don't know why it's not reflecting. Okay, now I can see it reflecting. All right, please can you confirm that you can see my screen before I go on? Because I know there's a difficulty, there's a lag here. So can you confirm if you can see my screen? If I may need to stop sharing, then share again. From my end, it's free. From my free share again. Okay, so X and Y are two. Somebody still making comments. So check now if you can see. Before I continue, check now if you can see. I just need one comment of somebody saying, I have seen the, okay, I can see it now. So that's the comment I need. All right, so November 2018, question 2. Let me take that down. November 2018, question 2. So let's go. X and Y are two divisions of the XY group of company. Division X manufactures one type of component which it sells to external customers and to Division Y. So what do we have here? X is the selling division. Y is the buying division. That's one thing we glean from here. Now the following relates to X. So this is the selling division. Oops. Okay, so sorry for right. So the following relates to X division, which I say is the selling division. Now the market price per component is 200. So that is what they sell to the market. Variable cost per component is 105. The fixed cost for the period is 1,375,000. Demand from division Y is 20,000. Capacity is 35,000. All right. So this is what happens here in X. Now, Y assembles another type of product which it sells to external customers. Each unit of that product requires two components that are manufactured by X. So we would say 2x, right, is equal to 1y. So you need two components of X to get one component, to get one of Y. So it means that if they are having 20,000 components coming from X, it means this is like say 2 times 10,000. So it means that if they have two, if what I mean here is if they make, if Y requires 2x, so it means that for every component of, for every unit of Y produced, they need 2 of X. So if they have given you 20,000 and you're taking them two in one, that means you need 10,000 of Y. You need 10,000 of Y. Okay, so sorry, this is what made a mistake here. So X is 2Y. That's what I want to say. So you need X, for X to be used in making Y, 2 of X need to be Y. So if we have 20,000, it means 2 multiplied by 10,000. So it means you are making 10,000 units. Another way is not to even use this like this. It's not to even do it this way. You can even say, instead of using this way, and we say that 20,000 is required by Y. And they are taking it 2, 2, 2, 2, 2, 2 components to make one. So just divide it by 2. It means we need 10,000 units of Y to be manufactured. So let's check. Selling price of this component is 800. Now, two components from X to be 2 at transfer price. That's fine. Other variable costs is 250. Fixed costs. Now you can see demand is 10,000 units. So is this 10,000 units that they are demanding, because they are using 20,000 components to make 10,000 units. And their capacity, they cannot do more than 10,000 units. Now, look at the group policy. Transfer must be at opportunity cost. What is opportunity cost? It means first, give buying division at variable cost when there is no conflict with market. Then they say if conflict, sell at market price. So if there is conflict, sell at market price. So transfer must be at opportunity cost. Then Y must buy from X. So it means you must satisfy Y first. Now calculate the profit for each division if the external demand for the component is 1, 2, 3. So now let's look at this that we have been given here. The company's name is XY Group of Company. So you can come here and say, what happened? How did I move from, yeah, we need to clean all of this. How did I move to page 7? Need to clean all of this and go to page 1. Wow. All right, so once again, this is performance management. The topic is transfer pricing. I can pass questions. And we are doing November 2018, question 2. And I'll say this is XY group. So now you will make our preliminary calculation now. So this is your X. So this is the cell. Then we have Y, buy. We have external. All right. Now, the capacity of X is 35,000. So you have 35,000 capacity. All right. Then you are giving X, Y how many? 20. So if you give Y 20,000, what will be remaining for E? External will be taking how many? 15,000. So in that way, everything is being satisfied. Now you'll be given 105 and 200. So this should be at 105 and this should be at 200. So in this case, there is no conflict. There is no conflict. All right. Now let's look at the, the first part of the question. It said, calculate the profit of each division if external demand is 15,000 components. So what you will now say here is this. You will now say A, external demand is 15,000 components. So what do? You say X capacity equals to 35,000. less Y demand between that say equals to available to start is 15,000. So this is what is available. We now say less external demand is still that is still so that no it means X is to 20,000, no problem. Now ask for just that, not going to be deficit in any demand. X can make 35,000 and they are going to give every out. You will now do now is you now set up your this is X, call it sell, this is call it buy. You will say here yes, external. So you're selling 15,000 units to external at the market price of how much? Market price is 100 naira. 15,000 times 200 naira. How would that be? So this is 15,000 times 200 naira. That will give you 3 million. So this is going to be 3 million because I put that share. So for the group is 3 million. Then you come here. Of course, we are still on external. We are still on external. We have Y we also sell its products externally. They are selling 10,000 units to the external market at how much? 800 naira. So it's going to be 10,000 units times 800 naira. So let's see what it's going to be. 10,000 units times 800 naira. That was 8,000. So this applies to Y. 8 million, right? 8 million. So that's going to be here 8 million. Now that we've done external, let's go down to the internal. Internal, okay, internal is going to be required, or is going to be done by only the X. So X is selling 20,000 internally at the variable cost of 105. So this is the very least it can sell. So 20,000 times 105 That will give me 2.1 million. So this is going to be 2.1 million. So it's not going to affect the group. So that's your sales revenue. So you will say total sales, it should give us 5,100,000. It should give us 8 million. It should give me 11 million for the group, right? So this is for total sales. So now let's go to costs. We have transfer costs. Transfer costs. So this 2 million here, this 2 million that was sold here as sales for X would that be a cost for Y. So that is 2,100,000 to now affect the group. Then we have variable costs. Variable costs. So let's look at variable costs. Variable costs. So let's calculate them one by one. We have 105. So this is 35,000 units that you sold both internally and externally. You produced them at 105 naira. That's your variable costs. So what is it going to be? That's don't know if my screen is being seen. Wow. Just hold on, my screen is coming up. All right, so variable costs for the selling division, the whole 35,000 it made is going to be produced at 107, and that gives us 3,675 from our calculation here. 35,000 times 105 is 3,675. Then we have that of, so when we do that, put a dash here, and this is 3,675. Then we do the second one, the 10,000 units it produces, the variable cost to it is 250 naira. So 10,000 times 250 naira, how much would that be? 10,000 times 250, that will give us 2,500. So I'll put a dash here. This is 2,500. That is 2,500. Okay, so when we add these costs, this is going to give us 3,675,000. This is going to give us 4,600. This is going to give us 6,175. So this is total variable costs. So let's look for our contribution. Contribution is going to give us sales minus variable costs. So let's do that now. Sales is 5,100,000 minus 3,675,000. That gives us 1,425,000. This is 1,425,000. That's the contribution. Let's look at the other one. We have 8 million minus 4,600,000. That will give us 3,400,000. 3,400,000. So what will happen to the contribution of the group? Group here is 11 million minus 6,175,000. That will give us 4,825,000. 4,825,000. And I said before, the contribution of the selling and the buying division must give you that of the group, because the transfer, internal sales and internal cost has cancelled out. So let's go now to the fixed cost. So this is fixed costs. What's the fixed cost for the selling division? 1,375,000. So this is 1,375,000. And that of the buying division, the fixed cost 900,000. So this is 900,000. So 900 is going to give us 2,275,000. 2,275,000. So profits. So this is the profit here. So let's do it now one by one. We have 1,425,000 minus 1,375,000. The profit is 50,000. So that's it here. 50,000. That's the profit. Now the profit for second one, we have 3,400,000 minus 900. Profit is 2,500,000. 2,500,000. Okay, so let's see the total profit for the group. 4,825,000 minus 2,275,000. That's give us 2,255,000, which is correct. 2,555,000, yes. 2,550,000, sorry. 2,550,000. 2,550,000. So that's the correct thing. So we've done for the first group, and we said that the profit for each group, see now, they particularly asked for the profit of each group, for the profit of each division. You'll find out that when we do the orders, the profit for the group will remain unchanged, but you'll see some improvements in each group performance when we do um, opportunity costs. So we've done the A part of it. So I will now give way for another color. It's this. Let's get to the B. So B, what's the B part of the question asking? Calculate the profit for each division if external demand is, we have done this, is 19,000 components. 19,000 components. So say external demand is 19,000 components. So what do? We start again. X capacity is what naira? 35,000 components. Y demand is equal to 20,000 components. And we said which must be satisfied. We say must be satisfied. So must satisfied. So when we less it, we now say available to external should be 15. Now say less external demand. External demand is 19. So there's going to be deficit. Deficit is 4,000. So how will that deficit be done? See this deficit, you need to look at it from Y demand. So you say therefore Y will be transferred as follows. See this 4,000 that is deficit to be at market price. 4,000 because they are shorting that of Y. They're shorting that of external market by 4,000. It is this 4,000 that they gave to Y because if external is demanding 19, Y should be having 16,000 units. But you see, they are giving them the whole 20 and they are shorting that of external. So that 4,000 that is short from external, they will give it at market price. So at market price of 200. That 200 market price is 200. Yes. Then 16,000 at variable cost of 105. So that is how then external will get just 15,000. It cannot get the whole 19 it asks for. So this available to external, it will just get this 15,000 at market price. Market price of how much? 200. So you come again, you will start the same thing we did before. So this is X, or this is sell, this is Y, sorry, this is Y, that's buy, and that is the group. So this is sales revenue. I will say external. So external, they are giving the external market, X is giving the external market 15,000 units. They cannot get the whole 19 that they demand because they said Y must buy from X. And it means the whole 20,000 Y needs must go to them. So they will short external market. But now we splitted it. That shortage from the external market, that 4,000 will be demanded at market price. So this 15,000, they are selling it to the external market at the normal 200, and we've got that to be 3 million from our last sales calculation. So that's 3 million. And these people will still sell their 10,000 components at, is it 800 naira? Let's see, we've done that before. 800, so that will still give us 8 million. So that's still, sorry, this is 3 million here. So this is 8 million. This is 8 million. External sales gone. So this is now internal. So internal, we're going to split it. 16,000 at 105. So 16,000 is going to go at 105. So let's see it. 16,000 at 105. I have 1,680,000. So this 1,680,000. Then we have the remaining 4,000 at market price. So what would that be? 4,000 at 200 naira. That's going to give me 8,000. So that is it 8,000. Let me check again. 800,000. I write the wrong thing. So this is 800,000 dash dash. So we are going to get our total sales. Total sales. So this is going to give me 3 million. Let me add them here. This 800,000. Let me add 1,680,000 plus 3 million. 5,480. So this is 5,480,000. This is 8,000, 8 million as before. And this is 11 as before. Now let's deal with our variable cost. Our variable costs will not change. So we have to change the little transfer costs. Now our transfer cost is going to be the addition of these two. So let's just do it now. 1,680 plus 800. That will give me 248. 2,480. Instead of doing it one by one, instead of taking this line and writing, then taking this line and write, just add the two and give the one figure here. But in this case, it is necessary to show them line by line so that you see how you derive, how you broke them down. But in this second one, we know it's an addition of the two. So we have other variable costs. So we have the first one, 35,000 times 105. How much did we get the last time we did it? 3675. And the other one is 2,500, 2,500,000. This is 3675. This is 3675. We don't need to do that again. Then we have 10,000 multiplied by 250. That should give me 2,500,000. This is 3675. This is 2,500,000. So that's for your variable cost. Variable cost here is total variable cost. This should be 3,675,000. This should be 4,980,000. Then this should be the same thing we got before, 6,175,000. So it's still the same thing we got before, 6,175,000. Irrespective of the transfer cost, everything here is, you can see the transfer cost is different here, but it didn't affect the group. The group is still the same variable cost, the same contribution will be for the group. All right, so let's look at the contribution. Contribution for the first one will be 5,480,000 minus 3,675,000. That will give me 1,805,000. 1,805,000. I'm getting my contribution, 1,805,000. So this is contribution. So let's see the second one. We have 8 million minus 4,980,000. That gives us 3,020,000. 3,020,000. Then let's see that of the company, 11 million minus 6,175,000. That gives us 4,825,000. 4,825,000. So that's your contribution. Before we go further, let's look at the contribution in this one and the previous one. Look at the group, 4,825,000. Let me write it down here, 4,825,000. Go to the group, contribution, 4,825,000. Nothing changed. The fixed cost is still going to be this same thing, and the profit is still going to be this 2,550. Nothing changed. But let's look at the contribution of this selling buying division. It reduces from 4,600,000 to 3,020,000. 3,020,000. Now, why did it happen so? It is because, remember that 4,000 quantity that was given to them at market price? It has increased the contribution of selling division, and it has now reduced the contribution of the buying division. Now, notice the contribution of the selling division It has increased to 1,850,000 from 1,000,000 for something, 1,425,000. It's because of that opportunity cost. So when they are selling at that 4 million at market price, you see it has increased the contribution of the selling department. And so their profit will increase by 50,000 to increase from 50,000 to something higher. Whereas the profit of this um, buying division will reduce from 2,500,000 to something smaller. Nothing will happen to the group. So let's look at it now. Fixed costs. So let's look at fixed costs. Fixed costs. Let's remind ourselves this is 1,375,000. 1,375,000. Let me do the profit immediately. Profit. So let's do it straight. 1,805,000 minus 1,375,000. So before I press equal to, previously it was 50,000, but it's going to increase now to 430,000. Whooping difference. 430,000. So that's the profit, right? Let's look at the other one here. Fixed cost is 900,000. So this is 900,000. So let's do the calculation now. We have 3,020,000 minus 900,000. Now you check, previously the profit was 2,500,000, but now it's going to be something smaller. Sorry, I didn't do this well. 3,020,000 minus 900,000. 2,120,000 as against 2,500,000. 2,120,000. So this is 2,120,000. And let's see that of the company. If I add these two together, this plus 430, that should give me 2,550,000 that we needed. 2,550,000 that we needed. Meanwhile, let's for formality complete this. We have 1,375,000 plus 900,000. That will give me 2,275,000. 2,275,000. So if we are to remove that, 4,850,000 minus 2,275,000, you see that we have our 2,550,000. So the group's profit, nothing touches it. Normally, I shouldn't be doing the group's profits, but for the sake of learning, so that you will get the hang of it, I had to do the group's profits to illustrate that the group's policy, it doesn't follow the group's policy, nothing is going to affect the profit of the group. But you can see the performance now. The selling division has increased this performance. You know, the first one, where there was no conflict, the profit was low. Now, the selling division now have a conflict between satisfying the external market and the Y division. and its profit increases because opportunity cost has come into the picture. So you see, X will always want, the higher the conflict, the more opportunity cost it will give to the Y division, and the more profit it's going to make. Now let's get now to the C part. Let's see the C part. Let's solve the C part now. So the C is external demand is external demand. So we've solved this. External demand is now 35,000 components. 35,000 components. So we see 35,000 components. How do we solve this? So let's see. You will say X capacity equal to 35,000 components. Like we did before, Y demand, much less Y demand. Y is demanding 20,000 components. So 15,000 is available to external, right? So external demand is 35,000. So 20 is the deficit. So deficit is 20. And normally the deficit is taking that 20,000 is going to affect what is given to Y. So it means that the whole 20,000 of Y demand will be transferred at market price of 200. So the whole 20,000 you are giving Y, you transfer it at 20,000 at 200 naira. None at variable cost because that is the same deficit. So we'll come back again and let's do our usual stuff. This is X. This is the selling department. This is Y. This is the buying department. Now this is the group. Okay. So this is our sales revenue. So we have sales revenue, and we'll start with external. So the external, 15,000 sold to the external market at 200 naira will give us 3 million as usual. This is dash, this is 3 million as usual. Then we also have 10,000 units sold at 800 naira will give us 8 million as usual. 8 million as usual. That's external. Then we have internal. Internal, we are selling 20,000. The whole of 20,000 for the internal is going at 200,000. That's going to give us 4 million. Because it doesn't affect here, it doesn't affect here. So when we have total sales, our total sales will give you 3 plus 4, that's 7 million. This will still give us our 8 million, and this is still going to give us 11 million, right? That's fine. Let's say variable costs. Variable costs, we have transfer costs. That's going to be dash. This 4,000 is being 4 million is being transferred here. 4 million. This is dash. Then we have our variable costs. It still didn't change because the variable costs we had here is still the same variable cost. This variable cost 3675 and 2,500,000 is still the same, and it didn't change because that's it. So instead of doing the same workings all over again, just pick that figure. This is 3,675,000. This is 2,500,000. Then let's look at the total. Okay, that is going to give me 6,175,000. 6,175,000. Yes, 3 plus 3, 6. This 6,175,000. So that's variable costs. So let's look at the contribution. Contribution to now improve. So this will give us 3 million something now. So we have 7 million minus 3,675,000. That will give us 3,325,000. An improvement, 3,325,000. Now, what is it going to give us here? A reduction, 8 million minus, so let's say minus 4 million minus 2,500,000. Normally, I should have my total variable cost. I didn't have that, so I'm just doing it straight. So your contribution is 1,500,000. Okay, so the contribution here is not going to affect. So this is 11 million minus 6,175,000. Contribution is 4,825. 4,825. Yes, that's it. Fixed costs, let's get it from them. This other one is 1,375 and 900. 1,375. 1,375,000. This is 900,000. The total will give us how much? 2,275. This is 2,275. All right. So what's going to be your profit? Profit. So let's do it now. Do I have my profit here to be 2,550? Nothing changes here in that profit. But let's look at that of the two groups. We have 3,325,000 minus 1,375,000. Improvement 1,950. 1,950,000. This is an improvement from what it had before of 430, and more improvement from 50,000. This one will now reduce drastically. We have 1,500,000 minus 900. That will give us 600. See the drastic losses. 600. So if you add these two, it will give us 2,550,000. So this is what is happening. That's how to answer this question in the A part. You have answered all the questions, the profit made by each division for all these components. And that's just 13 marks. Now, we go to the B part. Calculate the financial impact of the group on the group if the Y division ignored the transfer pricing policy and purchase the 200 components it needs from an external supplier for 110 naira each. Now they said your answer must consider the impact at each of the levels of demand. The impact on each of the levels of demand. The impact on each of the level of demand. Okay, so let's see. We'll come back again, the B parts. So let's go down here. We have a B. We now say B, okay, B1 transfer policy ignored external demand is 15,000 components. Now we are looking at the overall for the group. So what happens to the group? So this is X, this is Y, and the main thing is the group. So we have sales revenue. There is not going to be internal, never internal sales, never, because here they decided to buy it outside, and so there was no internal sales from X to Y. Everything is external. Everything is external. So what is going to happen now? So let's say the first one is because external demand has asked for 15,000, it's going to be 15,000 at market price, 200. That will give me 3 million, because this is 3, 3 million. Then these other ones here, they are selling their 10,000 goods at 800 naira. That will give us 8 million. That will give us 8 million. No external markets. So that's it. So total sales, this is 11 million. Is what they are selling, because this is 3 and this is 8. So that's total sales. Get to the contribution and get to the variable cost. Variable cost, there is no transfer. So what will happen is, I will say variable cost. This person is producing 15,000 for the external market only, and it's at 105 naira. 105 naira. So how much is it going to be now? 105, 15,000 times 105. That will give us 1575. So this is going to be 1575. Okay, 1575. And these other people are buying their 20,000 components. They are buying it where? At 170 naira each. This is the amount they are buying it from a standard supplier, 170,000. So they are buying at 170,000. Okay, so we have 20,000 times 170,000, 170 naira rather. This is 3,400,000. 3,400,000. So this is 3,400,000. Okay, so let's get it down here. This is total variable costs. This is 157. Sorry, forgive my handwriting here. 1,575,000. This is 3,400,000. Then that should be 4,975. Right? So let's get our contribution. Contribution will be 3 million minus 1,575,000. That will give me 1,425. 1,425. Let me quickly just do the fixed cost here so that I can just get fixed cost. I think the fixed cost was 1,375. 1,375. This other one here is 900. And that should give us 2,275. 2,275, yes. 2,275. All right, so contribution in the second one, 8 million. 8 million minus 3,400,000. That will give us 4,600,000. 4,600,000. Uh-oh, I was supposed to do the profit immediately. Profit 4,600,000 minus 900. Profit 3,700,000. 3,700,000. Okay, so let's see. This is 1,425 minus 1,375. 50,000. 50,000. So when you add these two together, or when you do it this way, total sales 11 million minus variable costs 4,975. You have contribution 6,025. 6,025. Then we remove that 2,275. That gives us 3,750. 3,750. 3,750. Now, take note, when we do the number two, we observe that this buying division will remain the same. Everything in the buying division will remain the same. Do you know why? Because they will always buy 20,000 components from outside. They will always sell these 10,000 units outside. They will always have these fixed costs. So everything about them will remain the same. But what will happen here is the X will increase if external demand increase. Contribution in the group will increase because X is increasing. Y will remain stable. So let's see that. Let's test it out. That's it. B2 transfer policy ignored. External needs 19,000. So external needs 19,000 components. So what happened? We usually want to see what the group will be like. So this is the group, which is our main focus. So this is our X, and this is our Y. As I said before, the Y will remain the same, X will change, group will change. Unlike the first one, group doesn't change, X and Y are the ones changing. So we have sales revenue, everything is external. This 19,000 that they demand, you sell it to them at market price of 200. We've calculated that before. 19,000 at 200. Calculated that before. Okay, no, that's the second one. Yes. Okay, no, we've not calculated because we have always been giving external demand. We have always been giving them 15,000. So now we are giving them 19,000. So we come here 19,000. We are giving it to them at 200. That will give me 3,800,000. So this is 3,800,000. So you see it has increased 3,800,000. So these people will always be selling their 10,000 at 800. That will always be 8 million. So Let's add them up. This will give me 3,800,000. This will give me 8 million. This will give me 11,800,000. So that's your sales revenue. We'll come here, variable costs. This one will be 19,000 at 105, 19,000 at 105, because that's how much it cost you to do it. So we have 19,000, 19,000 units at 105, and that gives me 1,995. 1,995. So I would have loved to do the contribution immediately. Contribution. So I have 1 million. Okay. I have 1,995 here, and I have my 3,800,000. I will just take this 1,995. Let me copy it and bring it down here. I will say minus, and I'll paste it. It gives me 1,080,000, 1,805,000. So I have 1,805,000, 1,805,000. Let me bring my fixed cost immediately. Fixed costs, and I'll calculate profit immediately. So fixed cost is 2. Ouch. Fixed cost here is 1,375,000. 1,375,000. So this is 1,375,000. So I'm calculating it immediately. So I will go straight down here. I have 1,805,000 minus 1,375,000. Now I'm getting 430. So you see here, 430. Can you observe what we are doing here with what we did before? We are getting the same thing for X. 50,000 the first time, same thing with the first one. This is because the 19,000 we are giving them here is at variable cost. 19,000 is sold to the market, right? But remember when we gave 4,000 at market price, it was at 200. So because we are only making what is sold externally, the variable cost and the external selling price compensate each other. We are getting the same price as getting the same profit. And it's going to happen in the next one we're going to do. We're going to be getting the same profit. So, but let's say this, that of fixed, that of B, the external, sorry, the selling, the buying division is still going to be the same thing that we had before. So we have 3,400,000. So I come here and say 10,000. Sorry, he's buying 20,000. 20,000 at 170. There should be other variable costs. Uh-oh. I missed that of I missed that of the I missed the first one here. I missed that other cost here. I missed that other cost. So I will amend it now. so that everything will look the same, so that we will not have to do anything different. So all we not need to do here is you add the 250 to the 170, because okay, no, it's not going to be that way. It's not going to be that way. It's not going to be that way. We are supposed to have added 10,000 times 250. Let's do that now. So everything we adjust. 10,000 components times 250. That will give us 2,500,000. That's what we're going to put here. 2,500,000. So this will still give us 2,500,000. So total variable cost will change. We are adjusting everything now. 2,500,000 plus 3,400,000. That gives us 5,900,000. 5,900,000. 5,900,000. So this is going to be 5,900,000. Sometimes in exam, these things happen. Plus 1,575,000. So this is going to be 7,475,000. 7,475,000. 7,475,000. 7,475,000. Your contribution is going to change. So we have 7,475,000. Take it from 11 million. We're going to have 3,525,000. 3,525,000. 3,525,000. So this is 3,525,000. Okay. So if we have to take 3,525,000 out, so we say minus 2,275. So that will give us 1,250,000. 1,250,000. So sorry, we are adjusting all this because of a simple mistake. 1,250,000. So let's redo this. Contribution here, we have 8 million minus 5,900,000. That will give us 2,100,000. 2,100,000. 2,100,000. 2,100,000. And if you remove 900 from it, minus 900, 1,200,000. So this is going to give us 1,200,000. 1,200,000. And it will still be remaining constant, 1,200,000. So it will remain constant, 1,200,000. So let's see here. So we need to adjust our variable costs. We need to adjust this line. 1805. I remember that. Let me write it down. 1805 for its contribution. So here, in the case of this, they are having their 200, the 20,000 multiplied by 170. So that gives them 3,400,000. Okay, 3,400,000. So this is, add them together. Come and do that now. 3,400,000 plus 1,995,000. That will give you 5,395,000. 5,395,000. That's 5,395,000. Then we also have this other one here, 10,000 multiplied by 250. Because that will give us how much did we get that time? 2,500. 2,500,000. So we have a 2,500,000. So we still have 2,500,000. Fixed cost here is 900. Add them to give me 2,275,000. So let's look at this second one here. 8 million, sorry, 8 million minus 3,400,000 minus 2,500,000. That gives us a contribution of 2,100,000. So 2,100,000 as we got before. So this is 2,100,000. So when we remove it from 900, we got our 1,200,000 here. 1,200,000 as before. It doesn't change. And let's look this other one here. 11,800,000 minus 5,395,000 minus 2,500,000. Contribution is 3,905,000. So this is 3,905,000. And if I remove the fixed cost minus 2,275,000, that gives me 1,630,000. 1,630,000. Can you notice that this is different from this? But this one remains 1,200,000 as before. This has increased. This has increased. Now, if you look at the third one, let's say the third one here, say B3, TP ignored, external equals to 35,000. So what's going to happen? These are X, this Y, and group, which is the most important. Sales here is 35,000 at 200. So 35,000 at 200, market price 7 million. So these people are having 7 million. So the group is having 7 million. Now, when this component was bought outside, they sold 10,000 units at 800 naira. They are still having their 8 million. The group is pocketing 8 million. So this is the total sales, no internal transfer. So I would say this is total sales. This is 7 million. This is 8 million. The group is getting 15 million. All external transfers. So let's come here. Variable costs. The first one is 35,000 at 105. 35,000, 35,000 is being made at 105. That will give us 3,675. 3,675. So the group is getting 3,675. Now, these other people are buying at 20,000 at 170. That's 3,400,000. The group is spending 3,400,000. Now, when these other people are still making the 10,000 units, they are making it at a variable cost of 250. That's still going to be 2,500,000. The group is spending 2,500,000. So this is how those other ones should have been. That's why the other space was smaller. So we have total variable cost. So I'll just come here and put my contribution. And I'll go down a little. I'll say fixed costs. First one is 1,375. And the other one is 900, giving us 2,275. Then I will go ahead and put my profit. Right. So I will take them one. Let me do the middle one first, which I know will not change. So let me do the middle one here. 3,4,000 plus 2,500. That will give me 5,900. This is 5,900. If I take away 5,900 from 8 million, that will give me 2,100, which is what we got before. And if I have to take out 900 from it, I'm getting my 1,200 back. This never change. So let's look at this first one here. Although we know that the ultimate thing is a group, but let's see. We have 7 million. This is going to be 3,675. 7 million minus 3,675. That will give me 3,325. 3325. Right? I'll now remove my fixed cost of 1375. I have 1950, just the same profit we got that time. 1950. Okay, so let's do the last one, which is that of the group. The group has 3675 plus 34 plus 25. That gives us 9575. 9575. So this is your total variable cost. Remove it from the sales of 15 million. That gives me 5425. 5425. Okay, then you take away 2275, and that gives me 3150. 3150. So that's how to do this particular question. So we've seen how all of these things pans out. We have seen how the external demand is being taken care of here when there is opportunity cost. Transfer price is at opportunity cost, right? So this is 13 marks here. This is 3 marks, which is 16. 4 marks. Explain the two attributes of a good transfer price. So it means that one mark in this each of them. So, but I had to go through this way so that you will see the impact at the levels, the impact at the different company. But here, you are told to do that of just the group. Here, you are not asked to do for the group, you are asked to do for each of the divisions. So even though you were putting group in the exam, don't put anything in the group side when you are doing the A. But when you are doing the B, everything should just be focused on what the group is getting. And so you just leave the calculation of the other ones, just see the impact on the group. So that's how you would do that. So let's see. So that means we've done this. Let me see. I want to be sure that we did this 2019 May, question 5. I want to be sure we did that 2019 May, question 5. If we didn't do it, then I will see how I will explain it. 2019 May, question 5. Okay. Yes, we did that. Did that. Opportunity cost. Did we do that? We didn't do it. So, but it's the same thing here. It's the same pattern. It's the same pattern. Look at the external demand. It's 150. Production capacity 175. Potential 800. I'm thinking we did this. Yes, we did that. Yeah, we did it. So this is almost the same thing. So that means that we've done that, just remaining this particular question. Okay, 2014, question number 1. Let me write the A1 again. A18, 2014, question number 1. 2014, question number 1. Yes. 2014, question number 1 is still talking about divisional performance. Still talking about divisional performance in, okay, the group's cost of capital is this, 2 division operating at this. Now, X budget, still the same thing, 150, 110, external price. All right. If Y provisionally requests quotation of 60,000 tires from X, determine what it should quote to meet its residual target. Okay, this question is divisional performance. We apply this divisional performance when we are taking this question. So permit me to solve this question again when we're taking divisional performance. So I will take this one to be A19. Let's change the color. So this is stroke 19 and stroke 19. So we are going to do this. So let me shade this one here very well to show that we are going to do this. We are also going to do this. Then which other question that has divisional performance so that we'll identify it, because our next class will be on divisional performance. That's going to be our next class, so that when we do that divisional performance, we are going to now solve that particular questions that are remaining. Let me check again. Let me still put question mark here. Let me still shade it. Come back here. Okay. So I think that's all. So, but you should also look at questions from November 2019 down to the recent years to see if you can see any question that has to do with transfer pricing and what we've learned. If you're having difficulties solving them after seeing the method we solve here, please refer to our video. If you still can get it, send me a message on WhatsApp, and I'll be happy to look at your issue where there is time. So thank you so much for coming to class today. We have done one full question where we exhaust the transfer pricing, and we saw transfer price at opportunity cost, and you see how it affects the external external market and the internal division that is being transferred to, and how the group changes or not change. We saw how when the group's policy was not followed, what happened? When the group policy was not followed and the other people had autonomy to go and buy and sell, found out that the group's the group's profit increased when in this case, when the group's policy was not followed, the group's profit increased. Meanwhile, the selling division, their profit was constant. The no, the profit was not constant. It was still the same as though when their policy was followed. It was still the same as though the policy was followed. But the group's profit increased in the sense that because they went ahead in selling, the buying department went ahead to buy from outside, they bought it cheaper than the market price. And so it improved the group's performance. But the the selling division did not have any significant changes from when it was following the group policy and when it is not following the group policy. So you can see sometimes in real life, we need to look at scenarios to see what will be the best for the company. Should we follow the company's policy or should we follow our own autonomous decision? Which one of them will make the company happy? So thank you so much for this class, and I will see you again in the next class where we'll be taking divisional performance. Do have a nice day.